typically, when an economy is growing strongly and a stock market is rallying, that tends to benefit the local currency. We're not seeing that right now, and I think that we need to return to conditions where you have stable domestic growth before that relationship kicks in again.
That was Michael Woolfolk, a senior currency analyst at Bank of New York Mellon, raising the question of why the dollar isn't stronger if the economy is growing and stocks are rallying. This is Taking Stock on Bloomberg. I'm Pim Fox. I'm speaking with Joe McAlinden of Catalpa Partners. All right, Joe, so what about that issue of the dollar? I mean, should we expect to see dollar strength if indeed the economy seems to be lining up, at least for your V-shaped recovery?
I think you'll get dollar strength about 6 months from now, but not before. The Fed has engaged in this massive easing of policy. There has been a huge quantitative easing and arguably a qualitative degradation of the Fed's balance sheet as it has bought all this stuff in the credit markets. And normally they buy treasuries, right? Treasury bills. So that would point to a weaker dollar, that by itself. Now, the process from money creation and this kind of liquidity flush, as Milton Friedman and all the great economists taught us, is not immediate. And the first thing that happens is the financial markets respond. 6 to 9 months later, the real economy responds. So the surge in U.S. economic growth that I'm looking for isn't happening this quarter. Or last quarter, but we think it's going to begin showing up in the fourth quarter, and then you'll have what we might call the mark of the beast showing up in the GDP numbers, which is I think you're going to get 2 or 3 6% growth GDP quarters back to back, and at that point the Fed's going to be thinking about tightening. If not tightening, the dollar is going to have a huge rally. But I believe until then, it's going to continue to be soft.
All right, so that's the dollar going to continue to be soft until, let's say, 6 months from now.
Right.
What happens in this 6-month period to the housing industry? I mean, do we continue to see this incremental improvement, or are we going to start facing a lot more mortgage resets, and then there are going to be clamors and calls for more intervention on the part of the government? Because basically the government is the private mortgage business now.
Right. And so the level of interest rates is important because that's holding down mortgage rates, and between the mortgage rates and the price of homes, the affordability has surged to unprecedented levels. And so that's a big positive for housing. But we've had a terrible, terrible downturn in prices, which has been a shock to homeowners and people who speculate in housing. And it's going to take a while to get over that. And so anything that happens, that shakes confidence or pulls support from the financing availability is going to be a negative. And one thing to watch, I'm a big monetary policy guy, and I think that fiscal policy is relatively much less more important. But in this case, we've had this first-time home buyers tax credit as part of the stimulus plan, and it's going to expire.
They're right. And there have been a lot of articles saying it's expiring too soon. People haven't been able to take advantage of it, right?
Right. Now, our guess is that this administration will extend it, will find a way to extend it, and that Congress will buy into it in spite of there'll be flap about it and other cash for clunkers and this and that. But I think, frankly, that's good policy. Even though I'm not a Keynesian, it's good policy given what we've just gone through. And they may even improve it in some ways. And if they don't do that, Pim, I think we could have a bit of a rollover in housing. But given that, I think you're going to see steady recovery.
Okay, all right. So let's assume that we get this extension of the first-time home buyers tax credit. What does that mean for housing stocks? Last time you were here, in fact, you mentioned housing stocks. You said, look, if you're going to be in the stock market, go with the areas where you're going to get the biggest bang for your buck, and one of them was housing.
Right. And so we continue to like the traditional home builders. But I think that if I'm putting new money in now, I'd buy a little bit of those guys and then think downstream of the housing purchase decision. When you sit down with your wife and you look at the empty house and you say, okay, how much of the old furniture are we bringing? In my case, my wife says, none. You know, so we go.
So
up
you end up buying a lot of things like you what, not only furniture but carpet, washing machines. You start putting in, filling up the house.
Probably a flat screen TV. Who wants that old, the old clunker TV?
You can't use the 36-inch anymore. You've got to go even bigger than that.
Right. So I think the home furnishings and everything that extends down from that.
I spoke to Stephen Chick just a little bit ago from Friedman Billings Ramsey. He just increased his stock rating on the shares of Lowe's, and he's got an outperform on Lowe's as well as Home Depot.
Home Depot. Yeah, those are great calls, and that's a place to put money to play an extension of this recovery. But also don't forget that to the extent that the additional buying, and we got a nice number this morning on purchase applications, additional buying of homes begins to buoy prices a bit. That tends to improve the picture for financial institutions that are still holding paper that's underwater because of the decline in home prices.
Right. Anything that starts to lift the value of those loans is going to make those balance sheets look pretty good.
Absolutely.
Talk, if you can, a little bit about the connection between the U.S. economy and the global economy, because I know you've also spoken about it in the past. You've also allocated some thought to what is going on in emerging markets. You've said, let's be in there. But, China, got to take a look at the stock market profile of China. It's not rewarding investors. It's
way off the high, clearly, and you know what that was all about, the bank loans and then the withdrawal of some of that. I think the Chinese market is going to recover and make up some of what it lost. I think what's more important to me, we don't invest directly in China, but what's more important to me is the impact of China on the global economy. And that, I think, continues to be a bullish story. The administration there is telling you they want the stimulus to continue, and that's bullish for world commodities and world trade.
All right. I want to thank you very much. Joe McAlinden coming in from Catalpa Capital. You've got that V-shaped recovery. We're still looking, and we're still going to follow what happens. Thank you very much for your insights.